Hey guys, it's Sasha. On Wednesday, 16th December 1998, a relatively unknown analyst from Oppenheimer called Henry Blodgett increased his price target for Amazon stock from $150 to $400. In his research note, Henry said that Amazon is in the early stages of building a global electronic retailing franchise that could generate $10 billion in revenue and earnings per share of $10 within 5 years. Instead of 5 years, it took Amazon 7 years to reach $10 billion in revenue and 19 years to get to the $10 earnings per share. But that didn't really matter, because on that Wednesday in December 1998, shares of Amazon rose by 19% to $289 as the stock market was beginning to hit peak .com fever. Amazon was the second highest rising stock on the stock market that day. On December 16th, Books A Million, another online bookstore, went up 80% in one day because they also happened to sell books online, and selling stuff online was the future, bro. Other online retail stocks also benefited. eBay went up 11% and BarnesandNoble.com was up 7% on the day, and at the time, this Amazon valuation appeared highly unlikely. Henry laid out part of his rationale for a huge price target increase while Amazon was continuing to lose money every quarter. He said, "As with all internet stocks, an Amazon valuation is clearly more art than science, and we believe that the stock will continue to be driven higher in large part by the company's astounding revenue momentum." Several analysts publicly said that this valuation is based on hot air and has no justification in numbers. But only 3 weeks later, on January 6, 1999, the stock did reach $400, split adjusted because the stock split 3-1 the day before because it just kept going up so much. And immediately after this happened, Henry Blodgett was instantaneously elevated to a godlike analyst status. He was offered a position at Merrill Lynch, reportedly getting a huge pay rise, and he became a popular cheerleader of .com stocks on CNBC, the sort of 1999 version of Dan Ives or Cathie Wood. But just a year later, in 2000, the .com bubble burst. Blodgett lost most of his own $700,000 that he personally invested in tech stocks, and he lost Merrill Lynch a huge amount of money that they invested based on his belief that tech stock valuations are more art than science. And shortly after they lost a gigantic amount of money, he was forced to part ways with the company and went on to never get another job as an analyst afterwards ever. 2 years later, the SEC charged him with securities fraud from when he was working at CNBC. Sorry, did I say CNBC? I meant Merrill Lynch. The SEC charged him with issuing materially misleading research reports on internet companies and making exaggerated or unwarranted claims about them to customers. The case was settled eventually with a $4 million plea deal, with Henry Blodgett never admitting officially any wrongdoing, but at the same time as he did not do anything wrong, he also received lifetime bans from ever working in the securities industry by the SEC, a lifetime ban by the New York Stock Exchange, and a lifetime ban by the NASD, which is the old organization that has now been replaced by FINRA. So this guy is now banned from ever working in the finance industry, pretty much because of making shit up to pump stocks. And today, Henry Blodgett is the CEO or chief editor of Insider, used to be called Business Insider. That publication that a few months ago printed a new story about Elon Musk offering a flight attendant a horse in exchange for a massage with a happy ending. And Insider also prints about 420 news stories every day about AI stocks going to the moon and being horribly undervalued because, of course, you cannot value them using outdated traditional approaches because valuations of AI stocks are more art than science. Some people are beginning to point out that the recent craze about artificial intelligence has some similarities with the dot-com bubble back in 99 and 2000. You can't watch CNBC for longer than 5 minutes before an analyst turns up to talk about the next AI stock that will definitely, probably, most certainly, maybe if you're lucky, go 10x in the next 3 weeks. Company valuations are not done on multiples of profit anymore. They're not done on multiples of revenue, but instead, the latest trend is to apply a multiple to the number of times the word AI is mentioned in the quarterly report and on the earnings call. Now, the big question is, What lessons can be learned from the dot-com crash, and how much do those lessons apply today? After Amazon hit $400, it didn't take long for the stock to go all the way to $600 before the dot-com crash wiped everything out and the stock lost 95% of its value. So on the one hand, Henry Blodgett and the other analysts hyping dot-com stocks were right, because those stocks did go up in value during the bubble, and they were praised a lot during the bubble for predicting this. And on the other hand, they were wrong, because then the stocks collapsed by over 90% after the bubble burst. And in the case of Blodgett's Amazon valuation, he still ended up being right in a way in the long term, because even if you bought in at the $400 valuation, suffering from FOMO after the stock blew up and then it was predicted to go up even more, and it did go up even more, if you bought then and you held the stock until today, you would still have gotten a 6,745% return on your money, which is 19.6% per year compounded. Although today's Amazon valuation is based on a PE ratio of 304, so yeah. But the important lesson is this. There were many internet companies during the dot-com crash that grew to an insane valuation based on a combination of hot air and traders gambling money in a stock market that was booming and would only ever go up. But that exuberance hides the fact that internet as a technology has gone on to completely revolutionize every aspect of our lives. And the few companies that did not turn out to be duds have made their investors incredibly rich. The problem is that back on the 16th of December 1998, Amazon was only the second highest rising stock. The number one stock was Books A Million, which went up 80% in a day. In fact, at one point, Books A Million increased in price from $3 per share to $47 per share in 1 week after the company announced a new website design. Roughly the equivalent of mentioning the word AI 1,000 times in one earnings call today. The big lesson of the dot-com bubble is that investors were not wrong about the future. They were not wrong about the internet. In fact, if anything, investors back in 1998 severely underestimated what the internet would do. At this point, Google was a completely unknown 3-month-old company after just collecting the very first funding round. But during a bubble, investors think that everything that looks shiny is gold. To an investor holding an AI hammer, everything that they see is a nail. Back in 1999, if you picked Amazon and you held the stock as a long-term investor, you would have absolutely nailed it. You would be rewarded handsomely and you would have made a crazy return. But at the same time, just a few months later, you would have lost 95% of your money, and you would have had to wait 10 years until 2009 for Amazon stock to return to its 1999 price. And during this period, you might not have felt as happy with your decisions. And today's stock market really does not resemble what we saw back in 1999. So it's important to be aware of the fact that the two are just not the same. Microsoft, the biggest company by market cap back in 1999, traded at a PE of 75 back then. Today's the second biggest company, but has a PE ratio of 38. Half. General Electric was the second biggest company in the index at the time and had a PE of 27. Apple stock is the biggest company by market cap today and has a PE of 31. The S&P 500 had an average PE of 30 back during the dot-com bubble, and today it's at just 22. So the S&P 500 was almost 40% more expensive back then than it is today on average. A point that many people have forgotten, though, is that the dot-com crash was not a market-wide collapse. People talk about it as though every single company went down and it was the worst thing ever. In fact, it was the opposite. The internet company bubble blew up in the face of investors chasing the latest fad, and as the Nasdaq fell 58% during the crash, the average stock in the S&P 500, if you ignore the valuations, was actually up 9%. The reason the S&P 500 overall declined during the crash is because so many of these Nasdaq tech companies had very high blown up valuations that exploded 10x out of nowhere. Cisco was at a price to equity ratio of 200, the sort of 1999 version of Nvidia that currently trades at a PE of 220. But the market outside of the overvalued hype stocks actually had a really good year in 2001. The S&P 500 equal weight index that ignores market caps and holds an equal amount of each stock actually went up 36% during the crash when the Nasdaq fell 58% in 2001. Now today we know that artificial intelligence is here to stay, and in the long run we will all reap the benefits of AI, improving productivity, improving the way that we lead our lives. As a technology, in many aspects it is going to be revolutionary, but AI is not something brand new. It has been slowly developing for many years already. It just so happens in the last few months was the first time when anyone started paying attention. And not every company that has the AI halo around it will end up being a good investment. In fact, history says that betting against the mindless hype of AI, the mindless hype of whatever the latest thing is, may be a much more lucrative investing strategy that doesn't lose you a shitload of money. Because every company that has any relationship to artificial intelligence has seen valuations go into the stratosphere regardless of whether there is merit to it. And unless you believe that every single one of these companies will become the leader of the future, the likelihood is that a significant number of them will not warrant those valuations at some point in 3 months' time, in 3 years' time, whenever that happens. Being cautious about companies valued as an art instead of a science does not mean that you don't understand the future, or that you are too dumb to understand the power of AI, that you don't get it, because that's the normal comment that you see all the time when you talk about this kind of thing. Every day you read news stories and hear analysts on CNBC egregiously promoting the latest AI stock, often making claims that are at best dubious and at worst could result in lifetime bans from working in finance and massive losses for everyone listening. And the stocks that are being promoted keep going up, so the masses keep piling in, suffering from massive FOMO and wanting to own the latest best AI stock because that's what everyone else wants to tell them to invest in. The main lesson that you can take away from the dot-com crash is that adjusting your investing strategy based on the latest hype trend could mean that you jump on the right bandwagon at the right time and ride it all the way up, although it is kind of already a little bit late. And then you can go on Twitter and tell everyone how amazing your powers of prophecy are, and maybe Merrill Lynch will then give you a job and you can go and repeat the same shit on CNBC.
I think from a hype perspective, this is not a hype cycle. I view it as more of a 1995 moment than in 1999.
Okay, that gave us 4 more years.
C3.ai is a company that is particularly popular right now. In fact, Dan Ives, the guy who was always on CNBC, has recently started pumping it and increased his valuation of the company by 100%. Even though none of the retail investors actually know what it does have the word AI in the company name, and ultimately that is the only thing that matters. Their most recent quarterly results show that revenue has grown 0.1% in the last year, even though there is a hype bubble going on in AI, and their operating losses increased 37% to $73.3 million, which makes for a negative 101% margin. A negative 101% margin. So the company's costs are more than double their revenue, and this situation is actually getting a lot worse quite quickly. But because the company has the word AI in the name, the stock is up 301% so far this year, and suddenly people are talking about it on CNBC. If this doesn't begin sounding alarm bells in your head, I don't really know how much more I can help. If you want to join this bandwagon and sell your stocks so that you can go and buy AI, all power to you, and maybe Nvidia, Palantir, and C3 will become the new Google, Amazon, and Microsoft. But then again, maybe they might not. And they could be a Cisco, which is still trading below its dot-com bubble valuation some 24 years later. Or they might go bust like one of the very many investor favorite internet meme stocks from 1999, like Pets.com. If you found this video useful and you want to continue the conversation, you can join my Patreon. The link is in the description, and you will get access to my Discord community, and I will see you in there. I'm in there all the time. Thank you so much for watching, and I'll see you later.